now the Fed potentially doing one or no rate cuts, or even potentially a rate increase, given what we've seen, in terms of the numbers, that would put, for the market to continue, a lot of pressure on growth, because growth has to deliver. Is that possible, or am I misreading the situation?
Well, I think what that speaks to, it wasn't that long ago when expectations were that the Fed was going to cut aggressively in 24 and 25. And all of a sudden, we've shifted the expectations now where hikes are the next, the next thing that's coming. It reminds me, if you look back over the course of the last couple of years, it reminds me of what we saw in the second quarter last year, where there was all this talk about the fact that the Fed was going to possibly hike as their next move. And the reality is the macroeconomic dynamics, they just don't move that fast. Like, the economy's slowly decelerating. The Fed is engaged in a modest easing cycle in response to that. And expectations are just whipping around wildly, whether it's aggressive cuts or a shift to hikes. And I think we're in one of those parts of the cycle here where expectations are getting overly enthusiastic that the Fed is going to not cut or hike ahead. That doesn't really make a lot of sense, given certainly their typical tilts towards dovishness, and the fact that the economy is certainly not in need of meaningful hikes, and whatever tightening could possibly have been needed has already happened through market-based measures, with the long end rising so substantially.
Countries like China,
as you look at these conditions,
antagonistic U.S. interests, by selling our bonds, that could be very detrimental to the U.S.
One of the things that I have seen mentioned by you in your Twitter feed is that to keep everything rolling, we need the consumer to, the consumer is not just most of it. The consumer right now is all of it. Can the consumer be all of it and continue to be all of it at a time when record levels of credit card debt, at record levels of credit card interest rate, and other problems along those lines? Or do you see, and do you worry about the consumer being exhausted, and that's going to be what winds up putting the kibosh on the party?
Yeah, and part of what's driven the stronger than expected U.S. economy over the last couple of years is a fair amount of business investment and continued housing investment, despite the fact that demand is down. And a lot of that was either related to the initial CHIPS Act or the Inflation Reduction Act on the business side, or frankly, a large backlog of housing starts that needed to be completion that were started several years ago. And I think probably all of us are familiar with the apartment building that was almost done and now is being completed and now coming onto the market. So those sort of corporate investment elements of the economy, which surprised the upside, are now fading. And basically, it comes down to household consumption, as you say. And household consumption has held up pretty well, in part because strong income growth has driven continued household demand growth. But the element that's really important is that households have been comfortable spending, continuing to increase their spending growth in line with their income growth, because asset prices keep going up, which means that they haven't had an impetus to save more out of that income growth. And so if asset prices start to level out and households feel like they need to save a little bit more, that's the sort of thing that's going to reduce their consumption and create a further slowing of economic conditions. And unlike the last 2 years, where business investment has been able to offset any weakness in household consumption, that too is slowing. That combination of things is not a great outlook for the U.S. economy over the course of the next 12 to 18 months. It doesn't mean that we're moving swiftly into a recession. It's just, when you compare that outlook to euphoric expectations, there's a gap there. And that's the sort of gap that typically creates an asset price weakness ahead.